So Goldbugs seem to be happy, and the idea is that once we break to the upside, reaching to 1800, we'll finally set the stage to have gold trading at 2000, and why not finally all the way to 5000, which has been the dream for the last 10, maybe 20 years for Goldbugs. Guys, remember, gold does not pay any dividend, so there's certain amount of restrictions that you may have with it. True, I agree. It's a perfect hedge to all the fiat money out there, to the dollars, all the euros, all the Great British pounds. It is true. I accept it. I surrender to your will, guys, but nevertheless, think about this for a second. You want to just have perspective of what is happening. We are in an environment that there is so much uncertainty coming from not understanding really how deep this sort of a handmade lockdown recession will produce. We just don't know. Nobody knows. And in times of certainty, cash is king. That will translate into more purchases of US dollars, which actually brings a little bit of a challenge of the US dollar being just a currency that now works as a safe haven. We have to put in perspective what is going to happen. Now, I just want to give you some clarity how far I think it will go and why. And you may decide to take the risk or not. But don't get too excited. Don't get too excited because based on market cycles, we're about also to experience another retracement. Massive retracement. The reason is, and a lot of discussion in circles of hedge funds is, gold is up for the year. Okay? And because it's up for the year, they're selling whatever is green. And having long positions green in gold allows them to change those for not only profits, but for liquidity for their hedge funds. And that's what they need. They need to keep a balance between the positions that they have a little bit rotten, a little bit not making money in the red. You know, a lot of them, they still have a lot of red C in their portfolios, and they're selling green to provide liquidity to do the redemptions. That makes perfect sense. So, having said this, let's take a look at two ideas that I want to share with you guys today before we start the North American session. First, take a look at this. I want to just pay attention and look at this Fibonacci. Why this trend Fibonacci? If you look at this section, this area, this portion, this is the pullback before the massive breakout to the upside. So this is the area I'm applying to take as my known bottom, which is $687. Remember those days? All the way back to 27, and I think it was my second year as a junior stockbroker. Now, if I have that information, I go to the known high. I can set it at $1,910. Doesn't make a change. See the fact that I'm just going to bring the pencil. See this. Now, look at this. At 61.8% Fibonacci, 1,150, it just kept having these bottoms. And it make it a historical multi-week, multi-month support at this level. Now, when we look at this from the perspective how high may go, I just can say that we will see 1900. Rest assured, mark my words, we're going there. Now, how? What kind of risk you have to take to fulfill your commitment, your goal, to achieve your goal of reaching out all the way to 1900? Well, it depends. I'm just going to share a few ideas and just place one trade with one standard lot on the synthetic, which what we trade a lot in Europe. XAU USD. That is gold against the US dollar. It's a synthetic. You're not buying futures contracts. Now, if this is true, there is only one way to go. It will go to fulfill the trend Fibonacci at the 0.0% level. What happens after that level is tricky. Why? Now, let's take a look at these analysis from the market cycle perspective. Now, again, remember, I have already said we're looking at gold at 1,900. It's something that is granted. Risk, on the other hand, how much risk you need to get there, that's a little bit of what you have to decide. You have to structure your position. Now, let me remove this and take out the trend Fibonacci, and let's work with my market cycle. Again, from the long-term perspective, I'm working on a monthly chart. Pencil, this is what we call the market cycle. The market itself, it has to fulfill and complete the cycle. The cycle started when the supply was created at 1900. Now, it created a massive demand at this level between 1000 to 900. That's your demand. And there's, well, missing an N. Don't judge me. I apologize, all right? Now, there's one particular aspect on both, the supply and this demand. Both are version. And there's something, oh, wow, just gonna go back. Okay. I said 1, 2, 3 over here. Market cycle completed. You have the supply and you have the demand. Easy. But in this case, both of these characteristics of this market cycle, they are verging. What that means, it's very simple. They haven't been touched. So, when you have a cycle that hasn't been touched on, or the zone, the supply or the demand, there's 90% of reaction that will take place. If the previous reaction was, look at it, it hit, excuse me, it hit 1900, what do you think is going to happen when it gets here? Especially in the verge of a recession, where hedge funds, they're just selling whatever is going to have enough liquidity. Think about it for a second. Now, there's some rumors here. The Bank of International Settlement was ordered to sell gold. Maybe. I don't have confirmation. I have no friends working at the BIS, Bank of International Settlement. Okay? And the other thing that you need to remember, central banks, CBs, okay? They're also providing governments with massive amount of liquidity. Where do you think they're getting that cash? Yes, selling gold. So, all good, leg up. Definitely, we're going to close the market cycle. 1900 is our last leg. I wouldn't be surprised if we hit 1950. Or why not, 2000. But the bomb is ticking. Because once we get to this level, we're going to start coming down to create a new cycle that is at this level. So in the next 24 months, don't be surprised to see a massive crash in gold and all the way back to 1,000. 1,000 again. And it's just because the characteristics of these supply and demand zones, those are version. And you have a 90% statistics support this, that once you get to that level, we will have a sell-off in gold. Remember, there are different conditions. Now, also, one more thing. One more thing, guys. I just want to, don't let you guys go without the whole thing. The full picture. Within a monthly. Okay? So you have the breakout again to the upside. You have this. You have this. A little bit of this. One, two, three. So somewhere around, we may find a little bit of resistance. It may do the same, and then to the stars. Basic analysis. Let's eliminate this, and let me just close the pencil. And let's bring trend Fibonacci one more time. So if I take this level, all the explosion can be, let's take it from this level, all the way to what we know so far, these levels. Look at the expansion of Fibonacci. If I take this level, and this is just a conservative analysis and view on this, you take this, which is from this bottom, 1,260, all the way to the unknown before the big retracement. This is why I'm using this level, 1,680, because from this point, we have this massive sell-off. And then you project, conservative speaking, I'm just going to use the 61.8%. I can say, okay, let's go from the 50, which seems to be the case. I'm just going to be conservative. There you go. Let me just, so it's visual. Everyone will have this information and can take action. Take a look. That's what it is. Our target, 1,850. But then again, a lot of what happens at this level is the famous FOMO, fear of missing out. Somewhere is going to kick here. You have FOMO, fear of missing out. Because now they think it's going to go past 2,000. professionally speaking, I don't see why it has to do that. Break the 2000. I can see it touching 2000 for all the reasons you know. Currency hedge, protect your wealth, all that is true, guys. But also remember, paying fees, you have to pay fees for someone to take care of your gold. It's true. Also, gold has no dividends. No dividends. I shouldn't be doing this, but okay. Using this pencil is just a little bit funny. And the most important, let me just remove that. Do I have? Now I just probably use it with the one. Okay, let me just remove this and use the one from MetaTrader. Something that looks big. Okay, and this is the most important. You do not eat gold. There you go. I said it. Here is. This is why I can see it happening. I can see it going all the way and touched 2000. And then goodbye. Based on market cycles, which we already studied, the cycle is completed at this level. Again, here, it's completed. When it happens, and it will happen this year in 2020, then you start to sell off. My expectation, we'll see gold trading back at $1,000. Yeah, you can say it's crazy. You can say you don't believe it. Just wait for it. You do not eat gold. And hedge funds and all different institutionals, including central banks, will sell gold to have liquidity because that's what we need right now. The reason why we didn't have in the S&P 500, the only reason why we didn't break down to 1,900 is because of the joint effort, synchronized effort of central banks around the world. There you have it. I said it. We will touch. This is the final leg up. And after that, brace yourself. Tie your seatbelts, guys. We're going all the way down to 1,000 in gold. For the War Room, Jose Ricaurte, Jaen.